As with any trading indicator, the stochastic oscillator, it's only a tool, and it should be used as part of an overall trading strategy. Now, I'm not going to draw a conclusion for you as to the effectiveness, but I'm going to cover different uses for the stochastic. I also am only going to cover the slow stochastics because I've always found the slow version much easier on the eyes than the fast stochastic, as you can see from this graphic. Now, you've heard of momentum in trading, and the stochastic is designed to give you an objective measure of the momentum in your trading instrument. It's bounded by the numbers 0 and 100, and it's going to oscillate between those two areas. Now, one thing you want to be clear on is that simply because the lines in the stochastic move up and down does not always track the price movement. Remember, it measures momentum, and that it tells you via the direction if price is closing closer to the highs or the lows over a set period of time. Now, some will say this is an oversold or overbought indicator. However, that was not the original intention of the indicator. George Lane, the developer of the indicator, he actually used it for divergence, the divergence of the stochastic when compared to price. Now, there's a big issue even when using the stochastic as intended, but for now, just keep in mind that we are looking at momentum in the market when using this indicator. Now, you may find different calculations depending on the charting package that you're using. However, this is the proper formula for the fast stochastic. The slow stochastic is calculated differently, where the K is a 3-period moving average of the fast K, and D is an X-period moving average of the fast K. But keep things simple. Even if your charting package has different calculations, just use what's available. Remember that any trading indicator is simply one cog in the wheel of a complete trading system. You will probably not rely on just one thing to indicate a trading opportunity for you. Now, many trading indicators will give you the opportunity to adjust many of the inputs that will be used in the calculation. This can be a good thing when trying to optimize for current market conditions, but it can really produce more headaches than trading results. If 14, 3, and 3 is a great setting, why not 13? What about 5, 3, and 3? What about any combination that you can think of? Keep in mind, though, that the shorter the look-back period, the more movement you will get with the indicator. A setting of 14 will be slower than a 5. But whatever you determine works for you, just be consistent. Actually, one of the reasons that I prefer the slow stochastic is I find that it plots smoother on the charts. The fast stochastic, it's ragged in appearance, which really has to do with it being more sensitive than the slow version. Now, there's no best stochastic setting that's going to produce more wins than losses. But when designing your trading system and your trade plans, simply choose the setting that suits your needs. I've always used the Napoli settings of 8, 3, and 3, and I've never changed it. That's not that I found that the setting was better or worse than any other. It's just that's what I started with, and I saw no compelling reason to change the setting. So now that we know that the stochastic is a momentum oscillator that measures the momentum of the last X periods to look back, let's look at some uses. Now, there are dangers when trading the often touted methods without taking a more critical look at not only what the indicator is telling you, but what price action and structure is telling you. Now, oversold and overbought. This is something that you read quite a lot, and oftentimes it misses the truth about these levels. These are not simply areas you just want to execute a counter trade position. We're looking at momentum, and momentum is high enough to force the stochastic lines into either of these levels. It indicates strength or weakness, and it does not signal an immediate change in the market. This chart here, it shows a market in both conditions, and you can see that overbought, the market just keeps going higher. Oversold, market just keeps going lower. So is taking a trade simply because of the signal of the stochastic a good idea? Not in this case, although I could probably find examples of the perfect reversal. So when testing anything in trading, ensure you're seeing the whole picture and not just what you want to see. When you see this condition, think of it telling you that at this point, the market is probably in a strong directional trend, and barring any support or resistance, it'll probably continue in that direction. But what I say probably? Well, let's go to Isaac Newton for that. An object in motion stays in motion with the same speed and the same direction unless acted upon by an unbalanced force. You will get counter moves, the unbalanced force, that may slow down the momentum of the market. But to reverse it, that force must be strong. That strength is often found at historical structure points. You may find opportunities when a confluence of technical factors line up when the market's oversold or overbought. This may be an opportunity to pull some profits out of the market, but you want to watch how price reacts around these areas. It must show some sign of weakness in order for you to find yourself in a higher probability trade. Now, there are plenty of opportunities for trades while the market is in both states. In this example, I can see range failure tests, range breaks, and flags that are broken with strength, and this is only using this one time frame. The key is using your trade plan to dictate your trading setups, finding them in favorable conditions, and executing them. Now, divergence trading. Price goes one way, the stochastic goes another. Divergence is usually the play that traders are looking for. Now, this was the original play that Lane was looking at when developing this indicator, but like I always say, an indicator signal by itself is not always the smartest opportunity. Now remember, the stochastic is bound in between 0 and the 100 level. It can't go lower or higher than those, so keep that in mind when you're looking at divergence. If price is in a downtrend, compare the lows of the price and the lows of the stochastic. If price is in an uptrend, compare the highs of price and the stochastic. If price makes lower low, but stochastic makes higher low, consider longs. If price makes higher high, but stochastic makes lower high, consider shorts. Now this is a downtrending price, and you can see that price puts in a low lower than the previous low. The stochastic puts in a higher low, which indicates the potential for a move up in price. Remember, the stochastic measures momentum, and even though price is moving down, the momentum calculation is pointing to the upside. It does not mean we're about to have a strong trend to the upside, though. This chart here shows the action after divergence showed up from the previous chart. Price action was not the most conducive to stress-free trading, and just looking at the candlesticks, you can see upper-lower shadows and small range candles. That said, though, the right side of the chart is a nice stair-stepping uptrend pattern that could have resulted in some trading profits depending on your trading style. You may be seeing a pattern in these two examples. It really does not matter when an indicator is telling you if price is not following suit. Indicators like the stochastic are an in addition to component of a trade plan that takes into account true market action and the structures of price. Now, the quality of the price trend. One component of a stochastic oscillator's trading strategy that you might want to employ is an objective measure of the quality of the price trend. If price is trending to the downside, your trading plan may call for continued short positions instead of counter trend trades. All trends are not created equal, and the stochastic will help you determine the quality of the momentum of the trend. This chart here shows a line cross well in the oversold area. This indicates momentum has turned bullish, and we are in an overall uptrend in price. You can see the nice separation between the two stochastic lines and indicates orderly price movement. Compare that to the area to the right of the highlighted zone. The lines are compressed together and price is plotting weak directional candles as well as strong directional candles, all while traveling in a sideways range. Look for separation between the lines as well as sweeping up or down moves of the stochastic to indicate a trend quality that you might find conducive to better trading opportunities. One important point to highlight once again is that the stochastic is a bound indicator. It's very likely that you can be in an overbought and oversold state with the lines tight together but still have decent price action for trading. The lines can't push higher than 100 or lower than 0, so ensure that you also take into consideration the state of the price action. Now, stochastic crosses, divergence, plus price. So we could take some of what we covered and add a few layers of confluence to it that may add to the probability of some price movement in our favor. To do so, we're going to add in some price structure to aid us in a trading decision. Trading an indicator signal blindly is a recipe for disaster, but adding in what the chart itself has to offer is a totally different ballgame. That is why NetPicks always incorporates 10 to 20% non-mechanical variables into each and every single trading system and plan. Now, one thing that we haven't covered is when the lines on the stochastic cross. We will cover it in the chart example, but if crossing to the upside from oversold areas, we consider that a bullish move. Why? Stochastic measures momentum, and And the cross signifies that after the move down in price, for example, we're getting momentum starting to the upside when the cross occurs. So do you trade when that occurs? Of course not. In the chart, prices moved down, it's put in the bottom, and then it rallied. Price came back down, and that's where we're going to pick up from. Number one, a double bottom. Price puts in a reversal candle. We're in oversold territory with bullish divergence. The stochastic line cross. Number two, counter trade off previous resistance. Stochastic line cross in overbought zone. There's no real candlestick reversal pattern here. Number three, a pullback to support and an upsloping trend line. Stochastic line cross in the oversold zone. Strong break of a doji type candlestick. Now this is making a case for trading as opposed to just firing off a trade because the trading indicator gave a typical and textbook signal. When you add in confluence of factors, including structure, you improve your odds of some move in your favor. Nothing is perfect, so having a trade plan that also includes risk tolerance and trade management is extremely vital. Now, trading the momentum trend. A slow stochastic trend is the momentum trend, and for this, you may want to consider using a MTF, a multiple time frame approach in your trade plan. Essentially, we're looking for the momentum direction on a higher time frame and then looking for trades on a lower time frame in the same direction. When using a multiple time frame trading approach, look for a difference of 3 to 5 times. For example, you can use a 60-minute trend for trades on the 15-minute time frame. Now, for simplicity, traders may look at the daily chart for the momentum trend, while in Forex, some traders use the daily 4-hour combo and the 4-hour 1-hour combo. Now here we have the daily stochastic on the bottom with 60-minute data on the price chart. You can see when the daily stochastic trend was up, there were multiple opportunities for trading ranging from flags to failure tests of ranges. The right side shows a daily stochastic trend to the downside with a cross to the upside midway between the oversold and the overbought. The trick is to note the slope of the thicker line and not to be seduced into finding long positions. To do so would have you in a losing trade quite quickly. There are a number of trading opportunities simply using structure levels formed as price stair steps downwards. Now, indicators are just part of the trading puzzle. There are still many people who believe you can simply apply an indicator to a trading chart, take the signals when presented. And as pointed out, to do so will not equate to a positive trading outcome. You need more. Simply applying the basics such as support and resistance or trend lines will at least give you something to trade against. They can also keep you out of taking trades directly into points of the chart that may offer some opposing forces that will challenge your trades. You want to ensure that any trading system you use that has indicators is also thoroughly tested, and if based on multiple indicators, that they complement each other. Having 2 momentum indicators, for example, is not needed and just adds a layer of complexity to any trading strategy. Remember, one of the key elements of a trading plan is how you manage your trades and the risk you will take. Those are as crucial, if not more so, than what setups that you use for your trades. Now, whether you use the slow stochastic as part of your trading plan or any other indicator, ensure that you critically analyze the information it presents so you can see both the pros and the cons of each. Testing a trading system and each variable, it's hard and it's tedious work. So if you think you're not going to approach it in a diligent manner, or you want to get ideas on how to design your own, you can join us here at NetPicks for a free webinar where you can see some of the most popular trading systems to date in action. And you can register for the trading webinar here.